let's start, and then anyone else that's joining, Pietros will just let them into the webinar. Morning, everyone, or afternoon. Thank you so much for joining us. I'm not going to be long with the intro, so we can give it over to Jaco immediately. Just a bit of background on Jaco. He is a CFA charter holder. He was previously a CFO at a multinational corporation based in Mozambique. So Jaco is very much a property expert, started investing in property from a very, very young age. And what we're really hoping to achieve is to give you guys some sort of insights into building your own property portfolio as part of diversification in your investment world. Jaco will give his details at the end of the webinar, but you're also more than welcome to contact me, and I'm happy to put you in touch with him as well. Awesome. Jaco, over to you.
Right. Good afternoon, ladies and gentlemen. It is such a great privilege to have each and every one of you joining today for this our webinar, and I'm very, very excited for the content that we are going to discuss on how you can create wealth through property. And we're going to look at property as an investment class. Now, there's so many different types of investments out there, and there's so many different things that people try to do to create wealth. And today we are specifically going to focus on property as a vehicle and how property can be used to create wealth for yourself. So I'm going to share my screen with you, and I'd like to touch on a couple of points on why property is such a lucrative investment. So before we start with that, I would like to touch on mindset, because everything that we create, everything that we do, everything that we see is determined by the lenses through which we look and how we look at the information out there. Now, ladies and gents, it's so important, like with everything, that when you hear certain things being said, that you pay close attention where it comes from and what it means and how to interpret it, because two people can look at the same situation and the one can see something very negative, whereas another person can see something very positive. So I just want to start out today to say that I am very proudly South African, and that I'm very excited about the opportunities that is in our country, and the tremendous amounts of wealth that can be created in our country. Now, ladies and gents, we've gone through such interesting times. We are literally seeing things that hasn't happened for, say, 100 years, and times are so different. And it is so important that we navigate through a storm like this with the right basis, with the right outlook, and with the right mindset. Now, we all know with Warren Buffett that speaks about how he looks at risk and how he looks at opportunities, and where he often says that when a lot of people are canning an investment, or when a lot of people are negative about an investment, that's actually the best time to make that investment. Investment that's constantly overperforming can't sustainably keep on doing that. And the same with an investment that's constantly underperforming if the substance behind that is there. So for me, ladies and gentlemen, and I assume that is applicable to absolutely everything in investment or in life even, is we need to be consistent in the things that we do. If there's not consistency in anything, the ability for you to become successful in that is very, very scarce. So the exact same is applicable, ladies and gentlemen, when it gets to property, is what strategy are you following? How consistent are you in that? Because property is the long-term game. It's not something that you buy the property today, you sell it tomorrow. Usually your outlook would be significantly longer when you look at a property investment. And it's important that you look at it from that perspective. So let's talk about property as an investment and why property is such a lucrative investment. And there's 4 points that I would like to discuss with you today, touching on property as an investment class and why property. The first one, the first point that I want to focus on is the returns that property generates. Now, it's very important before we speak about the returns that property generate, that we understand what those returns are. So in property, you've got two different parts or two different returns. And it is very, very important that you look at both of those returns. On the one side, you've got your capital growth or the capital appreciation of the asset. On the other side, you have your rental income, or what we speak of as your net rental yield or your capitalization rate. So if you want to understand what your return is on a property investment that you are making, you need to take both of those into consideration. You need to take into consideration that the asset is appreciating in value. And on the other side, you need to take into consideration that this asset can generate income for you. And those two returns together starts giving you a picture of the kinds of returns that property generates. But that's not all. For now, we will pause it there, and later we will talk in a little bit more detail about those returns and the things that affect those returns. So, ladies and gents, this is property prices in South Africa over the last 50 years. Now, it took me quite some time to get 50 years of data, and eventually my friends at APSA and at Lightstone could help me to put this report together. And the first question that both of them asked me was, why on earth do you want to have 50 years of data? Most people are interested in last quarter or the last 3 or 4 quarters. And for me, ladies and gents, the reason why it was so important for me to have 50 years of data is to get perspective. Because the perspective that a graph like this and the next one that I will share with you gives can completely change the way that we look at this and change the opportunities that we see in this. Now, an example that I very often use is that in 1995, the average size property would have costed you 175,000 Rand. This same property today would cost you plus minus 1.6 million Rand. Now, for me, ladies and gents, this is not just stats or data. I actually wanted to make sure that this is true. So I phoned my mother and I asked her, the property that we bought when I was in grade 2, how much did you buy it for? And when we sold it, how much did we sell it for? And what is it worth today? And to my surprise, it was very, very much in line with the stats that I'm sharing with you now. Then they often tell me about a property they had in Greenpoint in Cape Town. And I think they said they bought the property for 60,000 Rand, if I remember correctly. And that property today is worth 3 million Rand. And the regret that they have of selling that property. But this data, ladies and gents, I want to take this exact same data, and I just want to change the way that we look at it. And I want to see what is the year-on-year growth from the data that we've just looked at on property. And this is how it looks for the last 50 years. So you would, for example, see in 1981, think about that. Property prices in 1 year grew with almost 40%. Then you can see in 2004, that's also an outlier. We had property prices growing at between 30 and 40%. Now, something that immediately caught my attention when I looked at this graph is that in the last 50 years, there were only 3 years where property prices declined in value. And that was in 1985, 1986, and 2009. And if we look at the data right after that, in 1987, 1 year after 2 years of decline, we've almost made up all the decline that there was, and the same in 2009 and 2010. So that was something that was very interesting for me. Then I looked a bit further into this, and I looked at the trend that was taking place, and it made me realize again, with all the studies that we've done on investments and the case scenarios that we did, and to see the cycles, like with any investment vehicle. And one could clearly see how you've got your good years with lower years again, better years again, and then that cycle continuing. So that was something that was very interesting for me. And then something that also immediately stands out on this graph is to look at what has happened in property over the last 10 years. Because you can see that from 2013 onwards, the capital growth of property has become less and less and less. So we are in a cycle, in a phase with property where property prices are growing significantly slower than its 20-year average. Now, something that was very interesting for me is if you take this 50 years of data and you choose any 20 consecutive years, you can start it from 1969 to 1989 and you can run it year for year onwards. every single one of those examples will give you a year-on-year return of above 10%. In fact, I actually think there's, for a couple of years where it drops to about 9.9, 9.8% average year-on-year capital growth, but then it moves to 10 again. Now, of course, we are not seeing 10% capital growth in property currently, and that also wouldn't be sustainable. But over a 20-year period, up until now, any 20-year average will give you a capital growth. Remember, that's one of your two returns of plus minus 10%. So that is something that is very, very interesting to keep in mind. So ladies and gents, that's the first reason for me why property is so lucrative and why I love to invest in property. Then secondly, now this is one of the first things they teach us in the CFA is how to measure risk, right? And one of the first formulas that they teach us is standard deviation. And then later you separate the upside from the downside and all of that. But ladies and gents, what I absolutely love about property is that property for me is a low risk investment. And we can see it by going back to this graph that in the last 50 years, there are only 3 years that property lost its value. So property is an asset that tends to keep its value very well over time. And that for me is very important. When we look at the more, let's call it conservative investors like Warren Buffett, he would always say, rule number 1 is to never lose money. And rule number 2 is to never forget rule number 1. So that for any investor is an extremely important factor to consider. Yes, returns are great, but at what risk are those returns coming? And that is what makes property so beautiful for me, is the fact that it is a much lower risk or a very low risk investment. A question that I often ask is, how many properties do you know of that has plummeted in value? And very seldom would you actually see that. Most of the time, property tends to very consistently grow in its capital value as well as in the rent that it is producing. Then, ladies and gents, this is a huge advantage of property, and many people see this as a disadvantage, but property is a very illiquid investment, and it's a very unique investment. It's not like a stock where every stock looks the same from the one next to it. Let's say, for example, you've got Sasol shares. The one Sasol share doesn't look different from the other Sasol share. It looks the same. Whereas with property, every single property is different. And property is in a much less efficient market. Now, we often learn about the efficiencies of markets and the question on how efficient are markets, and the conclusion that many come to, that especially on your stock exchanges, that markets are actually very efficient and that information very quickly changes the price of a stock. But when it comes to property, the markets are not that efficient. And also, you work with individuals that are sometimes very subjective. Now, there's a lot of reasons why an owner or a seller would sell a property below market value. I like to call it the dark Ds. You know, it could be death, it could be divorce, it could be financial distress. So there's a lot of reasons that forces people to sell their assets below market value. Let's call it the intrinsic value of that property, which creates an opportunity for an investor to acquire assets at very good prices. So for me, ladies and gents, that's a great advantage of property. And then the last one, which is probably my favorite, is the fact that with property, you can use leverage. Now, I want to give you a classic or a simple example of what I mean with leverage and how we use leverage in property. And yes, I am going to take a lot of variables out in this example, but the important thing for me is to understand the underlying effect of how leverage is used in property and what the implications are of using leverage in property. Now, let's move to the right side first, which is a traditional investment. Now, let's say you've got 100,000 Rand to invest, and you put that 100,000 Rand into a traditional investment, and that investment grows with 10%. That means that your 100,000 Rand grows to 110,000 Rand, right? That's a 10,000 Rand growth or a 10% return on investment or return on cash invested. However, If you have 100,000 Rand and you want to invest in property, you are most probably not going to buy a 100,000 Rand investment. You will probably buy a R1,000,000 investment, use 100,000 Rand of your own money, and then when this asset appreciates in value, now let's assume this asset grows with 10%. It's not your 100,000 Rand, ladies and gents, that grows with 10%. It's the R1,000,000 that grows to 10%. So the R1,000,000 grows to 1.1 million Rand. Let's assume you still owe the bank 900,000 Rand, and you've got equity of 200,000 Rand. So even though the investment only grew with 10%, your return on your cash is in effect 100%. But ladies and gents, like you would know, leverage is a double-edged sword. What applies for the one side also applies for the other side, because imagine that this R1,000,000 Rand investment declined to 900,000 Rand. That's a 10% reduction in its value, a 10% decline in its value. Even though the investment only declined with 100%, with 10%, you lost 100% of your cash because the property is worth 900,000 Rand and you owe the bank 900,000 Rand. So that being said, ladies and gents, with great leverage comes great responsibility. You need to be very responsible when you use leverage in an investment. Now, I want to go back to, and specifically referring to residential property, that being my focus for today. Let's look at this graph again. Let's look at the downside risk. Let's look at the probability in the years where property has lost its value, where it has declined in value. And this will remind us and show us again that leverage and residential property investment actually goes very well together, because your downside is quite well protected with an asset class that's a store of value, or that tends to keep its value very well, which means that you can use leverage to amplify your returns. And ladies and gents, in effect, that is what leverage does. It amplifies whatever the effect is, or whatever the return is. It can change a 6% return into a 60% return, or a negative 6% into a negative 60% return. And that is one of the very, very big reasons for me, ladies and gents, why I today invest in property. And the fact that with very little of my own money, I could build up a property portfolio, a huge asset base that can appreciate in value. So, ladies and gents, that being the reasons why to invest in property, let's look at how a property investment looks. And I'm going to keep it very simple today, but these are very important things to keep in mind when you look at property as an investment. So let's look at the cash flow and the returns of property. On the inflow side, you've got three ways in which money can flow in when you are having a property investment, and that is either by the rental income. So you've got your rental income, that's the inflow. You've got your refinancing, which is a very interesting topic that I can speak hours about, because refinancing can be used to make huge amounts of capital available to expand your asset base, to, let's call it, cash out without losing the investment, and then to have your tenant pay the interest and the bond on that refinanced money. Or then, of course, you can sell a property. Now, I particularly as a property investor am not very fond of selling a property, because that's like killing the goose that lays the golden egg. I'll much rather try and keep the goose and get the golden eggs. But every person's strategy differs. Now, on the outflow side, depending on the strategy that you are following, usually you would have a bond payment, because like we've just said, often with property, you are going to use leverage. So you're going to use the bank's money to build a significantly bigger asset base. You've got your rental commissions for the property to be managed. You've got your levies that needs to be paid. You've got your rates and taxes that needs to be paid. You've got your maintenance on a property. A property, unfortunately, doesn't stay in a good condition forever. You've got vacancies, which is not actually an outflow. It's a negative inflow, but I put it under outflow. That's something you have to make provision for, ladies and gents. And then, of course, you've got insurance costs, which is sometimes covered by the body corporate if it's sexual title, or on a full title property, that would be an expense that you have. Now, let me give you a basic example of a property investment and how I would look at a property investment. Let's say there's a property that is worth R1 million, or you could value it at R1 million, and it is possible for you to buy it at 900,000 rand. Now, ladies and gents, for me, it is very possible to buy a R1 million property for 900,000. Like we have said, there are a lot of people that have to sell their properties, and that creates an opportunity to buy a property below market value. Now, if you buy a property for 900,000 rand, let's assume your transfer costs and your bond registration cost would be 36,000 rand. That investment, or the input cost, or the cash flow zero, if we want to look at it from an internal rate of return perspective, well, that's if there's no financing applicable, would be the 936. Property's worth R1 million. If you get 100% financing, the only money that you would need to take out of your pocket is 36,000 rand. Now, there's the first thing for me already, which we have discussed, is I can acquire R1 million asset with as little as 36,000 rand of my own money. Okay, let's look at how this property looks. And this is a good example of the rental yields and numbers being used here is very applicable to a city like Johannesburg, for example. Now, let's say your rental income on that R1 million property is 9,000 rand, and let's make the rental commission around 1,000 rand, which means that you've got a monthly rental income after commissions of 8,000 rand. Now you've got certain outflows. We work on 7,900 rand bond payment. Now that is very conservative, ladies and gents, because that's actually calculated on a 10% interest and not on a 7% interest. But it's also important for me that we keep in mind that interest rates can go up again, and you want to take that into consideration as well. Now, 7,900 rand is the bond that you would pay on a 900,000 rand bond if the term is 30 years, so if it's a 30-year loan. So you may ask me at this point, ladies and gents, is why on earth would you take a 30-year loan? And my response is always the same, because there's no 40-year loan available. Because, ladies and gents, when it gets to property, everything is about cash flow. You want to use as little of your own money as possible, and you want to build as big an asset base responsibly as you can, because that asset base is what creates the wealth for you with time then. So I would always take the longest term bond that I can, so that I can have the smallest shortfall possible, if there is a shortfall even. Then rates, we worked on 400 rand, a levy on 1,500 rand, and now you're sitting with a property that's costing you 1,800 rand a month. And I want to pause there for a moment, because most people stop there and say, you see, why on earth would you want to invest in property? Firstly, you have to take 36,000 rand out of your pocket. That's actually your cash flow zero. Then after that, every single month, you need to put 1,800 rand down on the shortfall, and that is not even taking vacancy or maintenance or anything like that into consideration. Doesn't sound like a very good investment for me. But if you take this and you fast forward a couple of years, now in a good economy, this could be 3 years. In a slow economy, this could be 5 or 6 years. Now you're sitting with a property that's generating 12,000 rand rent. Your rental commission is 1,400, so it's a 10,600 rental income. Let's assume interest rates did not change, so it's still the 7.9. Rates and levies grew with inflation, and you are now sitting with a 200 rand positive cash flow. And again, the naysayers will jump on and say, you see now, firstly, you had to take 36,000 rand out of your pocket. Then you had to take 1,800 rand out of your pocket. And then 3, 4, 5 years later, all that you see is a 200 rand positive cash flow. But ladies and gents, the thing that so many people forget is to look at the balance sheet. They just look at the cash flow statement or the income statement, and they forget to look at what is happening on the balance sheet. Because now you are sitting with a property that is not worth R1 million anymore. It is now worth 1.3 million rand. Let's assume you did not pay any money off or any amount off from the bond payment, that the bond payment was purely interest, and it won't purely be interest, it will be slightly lower than the 900,000, but let's assume it's 900,000 rand. Out of this investment, you have created equity out of 400,000 rand. Now, when I look at property, from a geared internal rate of return perspective. I look at what cash is leaving my pocket and what equity or net worth is that creating for me. Very much like you would do a project or an internal rate of return calculation. And based on that, I would make my decision on what to invest in. And that is why I love investing so much in property. Now, the moment that you use a model of refinancing that we've spoken about, ladies and gents, that is when there's equity in the property, you cash out on that equity by refinancing the property, which means your bond payment increases and which means that needs to be covered. That, of course, can often be covered by the increase in rental as rent escalate over time. But that capital becomes available for you to use for four things. Either you can just keep it in your reserve fund. And I want to talk about that, ladies and gents. When you build a property portfolio with a bank's money, or what we call a geared property portfolio, you have to have cash reserves. You have to have reserves that is accessible for you in case of unexpected events. Now, an unexpected event could be COVID-19. It could be vacancy. It could be an eviction. It could be maintenance that you didn't expect on that property, but it's cash that is accessible for you so that you don't have to take money out of your pocket to, let's call it, service your property portfolio or to cover for those unexpected events. So that is your FAT. That is your emergency fund. That is your reserve fund. And I've got a personal rule for every person. That rule would look different, but I want a 10% reserve, cash reserve on the value of my properties, which means I can still get to 90%, which is extremely high. But in the same breath, the risk is well managed, because for every R1,000,000 property that I own, I've got R100,000 cash in the bond or in the access bond. And the question that I so often ask investors and clients is, how much has to go wrong with R100,000? How much has to go wrong with R1,000,000 investment for you to run out of R100,000? On a R2,000 shortfall a month, that is 50 months of shortfalls that you've got reserved for. On a vacant property, and let's assume that property is costing you R10,000 a month, that's 10 months of reserve that you have. So even though you are geared extremely high, 90% geared in your portfolio, you manage the risk very well with the reserves that you have. So for me, that's the first thing that I do with refinancing. I don't save up for that. It will take me forever. So instead of saving up that 10% reserve every time, I would buy a property below market value. I would refinance it when the time is right. And I would use a portion of those refinanced funds to build up a strong reserve. Then the second thing that you can do with that refinanced money, which is tax-free, by the way, that's a very, very important thing to keep in mind, because it is seen as borrowed money, because it's money that you're borrowing from the bank, although you've got an asset as collateral against that loan. But that money can be used to build your property portfolio. You could be buying more properties with those refinanced funds. So again, without using your own money or a lot of your own money, you can grow your property portfolio. Thirdly, you can use it for shortfalls, to cover your shortfalls. Now, this is where you have to be very responsible, because now you are in a situation, especially as your property portfolio grows, where your property portfolio becomes bigger than you and your financial, what you are capable of financially. Now you have to make very sure those reserves are strong enough to cover the shortfalls. And then, of course, and this is the question that I get so often, so when do I actually benefit from this? It's out of those reserves and out of those funds that you make available in a well-oiled machine or a well-oiled business or property portfolio. You can start paying some of those funds out to you as payback of loans that you might have made to the entities over the years, or as compensation for, or a return for you to enjoy those funds. So that is just an introduction to refinancing and to leverage. Like I said, I can speak hours about this, but just to give you a little bit of a glimpse and a picture as to how we look at property investment and how we use leverage in property investment. Now, let's talk for a moment, ladies and gents, about investment structures and entities. You would have heard me speak about investment structures and entities. Now, ladies and gents, you do not want to own a single property in your own name. For me, there are only two ways in which you can own property. Either you are going to own it in a property trust, or alternatively, you are going to own it in a company with a holdings trust being the owner or the shareholder of that company. Now, you will see in both of these instances, a trust is the holding entity or the final owner of the property. So how you would not want to own property is in your own name, or alternatively in a company, but where the shares of that company is in your own name. Now, I know this can raise hundreds of questions, which we might not have time for today to cover all of it, but I'm definitely going to take some questions on structuring. But in short, ladies and gents, you don't want to have assets in your name. And the reason why you don't want assets in your name is because you want to protect your assets. So from a, let's call it a ring fencing perspective, or from a protection perspective, you want to protect your assets. So you want to put it in baskets outside of your name where it's protected and where it's kept safe. Secondly, you don't want to sit with a lot of estate duties, executive fees, capital gains tax, transfer fees one day when you pass away. The example that I so often use is that if you die with a 20 million rand estate, you can expect to pay between 5 and 7 million rand in costs. Capital gains tax, estate duties, executive fees, transfer fees. Ladies and gents, that's a quarter to a third of your wealth wiped out. Whereas if your structuring is right, that becomes irrelevant. Now, I know that SARS are not very fond of trusts, and they're not very fond of people moving wealth from their own name to a trust. Now, there are still ways to do it, but it is becoming more and more difficult. But one thing that is a no-brainer for me, ladies and gents, is to bolt your wealth from here forward in trusts and not in your own name. So that's just a quick glance on why you don't want assets on your name, but then also you don't want debt on your name, because when you are buying property in your own name, now let's look again at a leveraged portfolio where you are financing and you are using the bank's money to invest. The banks look differently at you when you are buying property in your own name than when you are buying property in an entity such as a trust or a business. You want to run your property portfolio like a business, ladies and gents. You want your property portfolio to be in an entity of its own, with a bank account of its own and financial statements of its own. Because when you now approach the bank for financing, it's not Joe Soap that is applying for financing. It is a business that is applying for financing. And the banks can actually look at the financials of this business, whether it's in a trust or a company, doesn't matter. And they can look at the financing on those terms. Also, when you buy property in an entity, you are falling outside of the National Credit Act, which means that different rules apply when it comes to financing. And that often enables you, ladies and gents, to build a significantly bigger property portfolio outside of your name than what you would be able to build in your own name. Now, ladies and gents, this is structuring for me is the foundation of your property portfolio. You want to have a strong foundation. You cannot build something big on a weak foundation. So you want to make very sure that you've got the right foundation for what you are building. So that being said, ladies and gents, I want to move back just for a moment and talk about leverage. We spoke about leverage in the form of capital or money or using other people's money, but there's two different kinds of leverage that I would like to touch on today before we move over to the questions and answers side. Now, I know this is very cliche, but I think it's very important to understand that. Often there's spoken about of OPM, OPS, and OPT. OPM being other people's money, or in investment terms, what we call gearing or leverage. OPS being other people's skill, using and leveraging off other people's skill to help you achieve your goals. And then probably the most important one of all is OPT, and that is other people's time, being able to leverage off other people's time. Now, I know that the majority of you that are joining today has got a severe challenge with the third one. You are all very busy and time is a factor, and investing in property does take time. Can it be built up as passive income? Absolutely, but you still need time. And so often when I'm approached and asked what option or what strategy should I follow when it comes to property investment, my response would be, well, let's first look at you. Let's look at your needs. Let's look at where you are at. Because for some people that have a lot of time doing everything themselves and finding the property and acquiring the property and managing the property is the perfect route to go. But then often I sit with clients that are executives or clients that are that's got a huge burden and huge responsibility in the corporations that they run, and they don't necessarily have the time to build their property portfolios. And when you find yourself in a situation like that, and the same applies to skill, you might not have the time to acquire the necessary skills to find that right property, to find that, or to manage that property effectively. And you can then find yourself in a situation where you ask yourself, but how do I invest in property if time is a challenge and if skill or the time to gain the skill is a challenge? And that is where we often sit with our clients and we look at how can you approach something like this. Now, this is a simple example of how we would sit with our clients and help our clients to build their property portfolios. We would establish a company with our investor owning a share in that company and us owning a share in this company. Some of the working capital will be lent to the company by the investor. That would be the money that we can't get from the bank to build the property portfolio. And then in this company, we would do the property acquisitions and we would do the portfolio management or manage the properties. So this then creates an opportunity for you to still benefit from the property sector or to invest in property, but where you don't have to do the work yourself, or you can leverage off other people's time and other people's skill. And then, like I say, from a other people's money perspective, still using the majority of the bank's money to build the portfolio. Now, what I love about property, like I've said, and especially when it comes to residential property, is banks give up to 30-year loans and they give up to 100% financing, which means that with little capital, a lot of properties can, or a big asset base can be built. So that would be a practical example of how you can leverage from a time and a skill perspective. Now, if this, for example, is something that interests you, I would love for you to make contact with me and to let me know that you want to talk about such a joint venture or such a partnership and how you can benefit from investing in property without having to spend all the time to build that property portfolio and to manage that property portfolio. Ladies and gents, then I want to close off before we move into the questions and answer section. I was hoping to do the presentation in 40 minutes. It's 12:40 now, so I think we've done quite well before we move to the Q&A section. And I want to leave one last or maybe two last thoughts with you. And that is the first one. I want to encourage you to take action. There's a lot of, I need to use the right word here because I don't want to step on anybody's toes because they are also important, but there's a lot of spectators out here. I don't want to be a spectator. I want to play the game. And one of the biggest challenges that I work with so much, and we see it in our seminars and we see it when we work with people, the mindset and the mental side is just as important as the skill side of building a property portfolio. Because the biggest challenge or the biggest lack that most people have is the willingness to take action. And that is something that I want to encourage you at. Remember, I had that slide on about consistency, how you consistently just need to keep on building your property portfolio and the wealth that can create for you over your lifetime. I want to encourage you to take action, to put a strategy in place. Now, property might not be your primary investment or your primary focus, but it definitely needs to form part of your portfolio. And I want to encourage you to take action, to take that next step, whether it is to acquire the first property, or maybe you've got a property, the first investment property, or to get part of a joint venture where you can be part of properties being acquired and building a property portfolio, but to put that strategy and that plan out for yourself of what it is that you want to achieve and to take action. And then secondly, ladies and gents, also not to be afraid to fail, because it is through failure that we learn how to become better at any craft or any skill. The first property investment that you make may not be the perfect property investment, but the amount of school fees and how much you would learn through it is worth every cent. So that is it from my side, ladies and gents. I would love to open the floor and give a little bit of time for us to do a Q&A session where you can ask questions. So I'm going to give over to Brandon again, if that's all right. And then I'm excited for us for me to answer some questions. Thank you very much.
Awesome. Thanks, Jaco. Guys, I know there's a couple of us on the call here, so we'll try and keep it as orderly as possible. But anybody got any questions? Anybody want to kick off? If you do, just unmute yourself and just give us your name, and then sure.
Right, I want to say you are welcome to ask the question verbally. You're also welcome to type it. I've got a couple of questions that I want to cover that I get asked very often, and that is, let's look at property as in while the questions are coming in or while you are typing it. You're most welcome to type it as well in the chat room. While we are waiting for that, question that I often get is, so with property investment, what is a decent return, or what is the benchmark? What do you benchmark it against? And then another thing that I've been getting very, very often lately is what's going on with property right now. So we've had COVID-19. We are sitting in a situation where things have changed significantly. Vacancies are up, defaults are up. How do we look at that? How do we approach that, and how does that affect our investments? So all of you are welcome to still type questions while I'm waiting for you. I've got some very important slides that I want to share with you that covers a lot of this. Now, this is from TPN, which is a company that's doing phenomenal with providing us with data and information that is very, very valuable. So when we speak about returns, we've got what we call your gross rental yield and your net rental yield. Remember, that's one of your two returns. On the one side, you've got the rental income and the cash flow side of it. On the other side, you've got the capital appreciation or the capital growth side of it. So this is, and I want to look specifically at sectional title. Purely because very often when you have a property investment, it would be a sectional title property. You are sitting with a gross rental yield that has been relatively consistently of about 10 to 11%. Now, my personal benchmark is a little bit higher than that. It would be the same type of properties that I invest in, but I don't just want to be average. So my benchmark would usually be to get a gross rental yield of plus minus 12%. That means that if I have a 700,000 Rand or a 750,000 Rand property that I buy, that I want to at least see a 7,000 or a 7,500 Rand rental income before expenses, so gross in other words. Now that can bring your net rental yield, which is after your expenses such as your commissions and your levies and your rates and all of that, to probably between 6 and 8%. So you've got one part of your return being 6 to 8%. Then you've got the other side of your return, which is the capital growth. Now here, it could be very high or it could be very low, depending on where in the cycle we are at. Currently, let's say that is at a 3 or a 4 or a 5%, depending on where you are investing and the price range of property that you are investing in. And those two combined gives you your nominal return. But then, of course, we use leverage to significantly increase that return. I see there's quite a lot of questions that's coming in, so I want to jump to that first.
I think a lot of the guys will be quite keen, so maybe we could delve a little bit more into that JV structure that you offer, because I think a lot of guys here are very busy and sort of guys that don't have a lot of time to do it themselves. So perhaps we can delve into that. And then there's just two questions here from Kerry. I'll read it out for you. You can just answer it. So the first one is, with uncertainty in the property market as it is it better to invest in private or commercial property? The second one is the best city to invest in South Africa in terms of property. And how easy is it to invest in property offshore?
Right. Thanks, Gary. Those are really very, very good questions. And I'm very excited to answer those. Let's move to the JV structure first. And let me speak a little bit about how we would structure an investment with the partner. Now, there's a different of couple ways in which you can invest. Now, you can create a fund and you can do it all corporate, but you lose a lot of your leverage ability by going that route. Or you can do what I like to call conduct guerrilla warfare, where you've got a lot of smaller entities with partners, not 10 partners, one partner, and you together build a property portfolio in a company where you can make use or benefit of the longer term loans and the higher percentage loans that banks give on residential investment property. So how that would practically look is you would, for example, say that you would like to invest with us in property. We would go through all the details. We'll agree on all the terms. Then we will establish a company. Both yourself and us will be directors of this company. And that company will then be acquiring property. The shareholding, like I said, is your trust will hold your shares. Our trust will hold our shares so that it's well protected, so that it's well ring-fenced. And this will become a property investment company or partnership. Remember, this is not a fund that you are investing in. This is a partnership. So this company would then acquire property and we would make use of like I said, the up to 30-year loans that banks offer and the up to 100% financing that banks give to build the property portfolio from there. So, for example, if we've got different packages or different sizes that you can work with. Now, let's say you've got, for example, R1 million to invest. We can put the R1 million in the company as a loan. So that would be a loan at either a fixed interest rate or prime interest rate or whatever the case may be. And that loan would earn interest for you. So that would be the first part of your investment. But the second part of your investment is you will own a percentage of this company. And this company will then be acquiring properties. Now, with R1 million, let's call it working capital, because that is in effect what it is. We're going to use it to pay the transfer fees, the bond registration cost, and the shortfalls. The rest of it we'll keep in the access bond accessible to expand further. We can probably after the first round of refinancing, get to about 10 properties. So you would build up a property portfolio with a, let's call it an asset value of about R10 million or just short of R10 million. And you would own a percentage of those properties. But over and above that, your loan would earn interest for you. And how the terms would usually be set out and how I work with my investors is that your loan and your interest will first be paid back before any other dividends or returns are declared. So before myself or my team benefit from this structure or from this joint venture, you need to get your capital back. You need to get your interest on that capital back. Let's call it, for example, a 6 or a 7%, whatever the case may be. And only after that, the proceeds of this portfolio will then be shared in proportion to the shareholding. So, like I said, the main responsibility of the investor would, of course, be to put down the working capital, where the main responsibility on our side would be to acquire the properties, good properties. You'll see I marked. Usually, I would aim to acquire a property 100,000 rand below market value because, like that one slide that I said, in property, you make your money when you buy. So you want to make sure that you acquire these assets at good prices. So we would be responsible for the property acquisition, like I said, and then also for the portfolio management to ensure that the property portfolio is being managed well. And we make use of our team for that to make sure from the payments to the rental agencies to the maintenance to all of that is taken care of. Great. I'd like to go to Kerry's questions then as well. Maybe any questions on this before we move over to Kerry's questions? Brandon, anything else that I need to cover on this?
No, I think it's good. I think we can go to questions.
Great. So, Kerry, you asked quite a lot of questions here. The first one that you asked was private, or let's call it residential versus commercial property. Now, both, let's call it asset classes within property, has got its advantages and its disadvantages. I've personally always loved residential property. And I mean, we spoke today about post-grad formulas such as geared internal rate of return, but now I would like to go back to grade 4. What shall we call it? Let me just say what we learn in grade 4, and that is basic human needs. So we've got 4 basic human needs as individuals. That would be food, water, clothing, shelter. Some people think Wi-Fi is also a basic need, but that's actually not true. There's only 4 basic needs, and one of those 4 is shelter. And the thing about residential property that I love is, irrespective of what happens in the country, irrespective of how well or how unwell it goes, something that's going to be here for a long time is people are going to need a place to stay. And if you develop your strategy right, to invest in the right kinds of properties, the luxury property in a fancy estate of 4 or 5 million rand is not necessarily, and I'm saying necessarily, but not necessarily the right kind of investment. When you are investing in the right properties, there's always going to be demand for your properties. You are always going to have people that need to stay in the properties that you have. I love residential property, but that does not mean there's not opportunities in commercial property. There's a lot of opportunities in that as well. Then the best city to invest in property in South Africa. Now, that's a very dangerous question to answer, and it doesn't matter what I say, somebody's going to be upset with me. So I'm going to answer this question very diplomatically. Now, let's go back to what it is that matters. What matters for us is the return that we generate. Now, there's 2 components to the return. So one side, you've got what we call your net rental yield, which is your rental income. On the other side, you've got your capital appreciation. Now, the question that I would ask back to you is, which one of those 2 are more importantly? Because, for example, in a city like Cape Town is known for a long time to show a significantly higher capital growth than Johannesburg. But then in the same breath, Johannesburg has shown for a very long time a significantly better net rental yield or rental yield than Cape Town. So there's a lot of considerations that you need to take. There's a lot of things that you need to consider. One of the big things, like I said, is you make your money when you buy. So where can you acquire property at good prices? Where do you know the areas well? Where are you operating? I know a lot of people say don't be bound to your own city when you invest in property, and I agree with that. But also in the same breath, that's a great place to start because, especially if you're doing it yourself, because you know those areas better. You know what properties are selling for. You know what properties are renting out for. And I almost want to say, in any area, you can make good money if you play the game well and if you do what you do well. But I like the big cities. Now, urbanization has been, up to a year or 2 years ago, a no-brainer. I personally don't think something like COVID would stop urbanization. It might slow it down in a third world country. In the third world countries, we're not talking about Europe or the USA now either. But I still believe that medium to long term, that Africa will urbanize quite a lot still. So I love investing in the big cities. So I would often look then at cities such as Johannesburg or Pretoria in Gauteng, Durban and surrounding areas in KwaZulu-Natal or Cape Town in the Western Cape. That being said, I've got clients all over the country, and many of them are doing brilliantly in various cities and towns across the country. So I'm going to leave it there. I think that gives you a good overall picture of how I look at that. And then you asked if it's easy to invest in property offshore. Now, a question that I very often ask my clients when they ask me this is, why do you want to invest offshore? Now, if it is from a hedging perspective or a diversification perspective, it makes sense. Yes, you don't want all your eggs in one basket. You don't want necessarily all your money in South Africa. But we are probably sitting in one of the best countries in the world to invest in property. And in fact, there are a lot of foreigners that are buying up property in South Africa because of the opportunities that are here. Now, Kerry, the best opportunity that you have, or the greatest opportunity that you have in buying property in South Africa is the fact that you can use leverage. You can buy R1 million property with 36,000 Rand of your own money. When you take that money offshore, suddenly you're a foreigner. So banks are not going to give you 100% financing. You might get 50 or 60 or 70% financing if you're lucky, which means that the capital that you need to put down is significantly more. And that means that the asset base on which you can build your wealth becomes much smaller. So it is possible. There are opportunities. There are a lot of South Africans that's investing in property offshore. However, I am not convinced that the returns look better than those that are investing locally. We are actually sitting with huge opportunities here. One thing that I want to say on that point is I personally think that property is greatly undervalued in South Africa from a global perspective. I've got a lot of international clients, and the reason why a lot of them invest in South Africa is exactly for that reason. We've had the discussion so many times before. Where in the world can you buy a 2-bedroom apartment in a good suburb in a world-class city, such as Johannesburg, for example, for 50,000 US? It's just not seen, not even in Africa. I worked all over Africa, and property prices are easily twice, if not triple, the cost or the value than what it is in South Africa. Great. I think those were the questions that we could get.
So if we've got some time, if anyone needs to go, please feel free to jump off. We know guys are busy, but let's maybe try to finish these last 2 questions.
Great. Perfect.
So let's quickly go to Rolene's question, then we'll go back to Rob.
Perfect.
Rolene's question says, how do you foresee the proposed land reforms affecting investment in residential property?
Rolene, thank you for that question. I actually didn't cover that today, and I think that's a very important thing to cover because it creates a lot of concern for a lot of people, and a lot of people are worried about this. So let me think of which angle I want to answer this, because there's so much that I want to say, and we don't have all the time. But let me start by saying this. As long as banks are still willing to finance individuals to acquire property, I personally don't think you've got very much to be concerned about, because there's no way that, and I want to call it a first world financial sector like we have in South Africa, would finance assets and properties if they are concerned that the very asset that is collateral could be taken away. And they would most definitely have severe defaults on the loans, because you can imagine if you've got a property and it gets taken away from you, or you lose that property, there's no way that you are going to pay the bank. In fact, it will crash the whole financial sector and the whole economy. So I personally don't see that as a big risk, and maybe this is a little bit of my own opinion as well, but also based on a lot of conversation with a lot of people, a lot of reading, a lot of research, and so on. I personally think that land reform and the risk that you have of property was blown completely out of proportion by the media, and that what was intended with land reform is not necessarily the message that the media gave to the general public. That's my personal opinion. But it's also based on a lot of facts. So I don't see it as such a big risk as what it's often made out to be. Over and above that, I also think it's a much bigger risk for the banks, since most properties are highly geared or financed by the banks, than it is for you as an individual. So that being said, don't want to get too much off the topic as well, but even in a country such as Zimbabwe, that have seen massive reforms in this. Residential property in the cities was very little affected by that. So the question that I always ask is, from whom would it be taken and to whom would it be given, or how would it be restructured, or how would it be implemented? And that would be a very, very difficult thing to do. And like I said, I don't think that is the intention of what was said. So again, I think I could cover quite a lot of time on this, but that gives you a little bit of an overview of my opinion on this.
Awesome. And then the last question from Rob. He says, we are seeing municipalities across South Africa being mismanaged and taxpayer funds stolen. We have seen rates and taxes increased almost 100%, even in the big metros like Pretoria. He says he has personally seen his property portfolio in Newcastle and KZN increase from 140 per month to 600 per month within 10 years. How much of a risk do you see with this?
Thanks, Robert. Very, very, very good question. And such an important thing to keep in consideration. Now, that being said, plays such an important part of your investment, because this affects your return, how much you are going to pay in rates and taxes, and then in things like levies, at the end of the day, affect the return on investment or the internal rate of return that you are going to generate. So it is a definite risk, and that is why that should form a big part of your basis of, or your decision. We had Kerry asking which cities to invest. Is when you decide in which cities to invest, it is critically important that you look at in which municipalities do you want to buy property. Where are municipalities well run, or where is it run well enough, if we have to say that. But it forms a very, very important part of your investment. Now, that being said, and it's a difficult question to answer as well, because where is the end of this? Can it indefinitely continue to grow at 100%? It can't, because it's not sustainable. It's not possible for rates and taxes to continue to increase at the rate than what it has. But is it going to slow down? That's the challenging question. Now, my experience has been in many of the cities where I invest, and in the municipalities where I invest, where I've actually had quite a pleasant experience with the municipalities, where you don't necessarily, where you receive good services, where it's relatively well managed, or where the municipality does well in what they do, well enough at least, and where rates and taxes are not skyrocketing. Yes, it is growing, and maybe something that is a little bit of a pain or a irritation for me is that it is growing faster than inflation, but where it's reasonable. Then one last thing that I want to say on that, Robert, and I think this is a very, very important thing to keep in mind, and that is to take a step back and to look at macroeconomics, to look at supply and to look at demand. You've got a certain number of properties. You've got a certain population size or number of people that need to live in those properties. That balance will always be there, not in the short run, but the correction will take place somewhere, because, and the same applies to interest rates. If interest rates starts going higher, and if rates and taxes starts going higher, it means it becomes less lucrative or more difficult for somebody to buy a home, which means that there are more tenants. And that could often then result in rentals increasing. So the impact of rates and taxes increasing is not necessarily only going to fall on the landlord, or even in some instances on the landlord at all. It could fall on the end consumer or the tenant that needs to pay the rent, because rent would then start escalating. So that is also something to keep in mind when it gets to the municipalities and how well the municipalities are run. I hope that answers your question. Like I said, I think that's a very complex question that we can talk very long about as well. But I think we got the basics covered on that.
Awesome. Thanks, Jaco. if you guys would like to get hold of Jaco, Jaco, you're going to put your contact details just on the screen there. But otherwise, you guys all have my email address. Feel free to drop me a mail, and I will happily give you Jaco's details and put you in touch with him as well. If also with your guys' permission, I will give him your guys' emails, and he can add you to his distribution list on his monthly investment property newsletter as well. Cool. I think if there's no other questions, one last opportunity. Any questions? Awesome. Okay, guys, thank you so much for everyone for joining. Jaco, thank you so much for your time. Really appreciate it, and everyone have a great day.
Thank you very much.
Cheers, guys.